Japan just handed Sanae Takaichi a landslide win, and the most powerful economic mandate the country has seen in decades. She wants to spend more, arm faster, and push the Bank of Japan to lock in inflation driven by wage gains, not just higher import costs. She wants all of this in a country already sitting on around 240% debt to GDP and a bond market that global traders watch every night. So here's the real question. Did Japan just solve its lost decades, or did it load a new risk into the global financial system that shows up in your bond funds, your equity ETFs, and even your retirement account? If you're an investor holding broad index funds, global bond funds, or Asia-focused ETFs, Japan just became a live risk switch on your dashboard. To see why Takaichi's win matters this much, you need a 60-second rewind. Post-war Japan became the showcase of the American capitalist model in Asia. U.S. security guarantees, access to the U.S. consumer, and huge support to rebuild heavy industry and export sectors. By the 1980s, Japan was an export powerhouse, its stock market was on fire, and land in Tokyo was famously valued higher than whole countries. Then the Plaza Accord and aggressive yen appreciation crushed Japan's export edge, fueled a stock and land bubble, and set the stage for the crash that kicked off the lost decades. In the 1990s and 2000s, Japan slid into deflation. Prices were flat or falling, wages stagnated, and households learned to expect that tomorrow will be cheaper. The government borrowed heavily, and the Bank of Japan stepped in. Zero or negative interest rates, yield curve control, and huge purchases of government bonds and even equity ETFs. It kept the system stable, but it also created a world where money from Japan was effectively free to borrow and where domestic investors looked overseas for returns. Fast forward to 2025 and 2026. Sanae Takaichi wins the ruling party leadership, becomes Japan's first female prime minister, and then calls a snap election to cement her mandate. The bet works. Her coalition scores a landslide in the lower house, giving her the parliamentary firepower to push a much more aggressive fiscal and security agenda. This is not a small reshuffle. It is a reset of how Japan mixes politics, economics, and geopolitics. Takaichi's message is simple. End the deflation mindset, protect households from rising living costs, strengthen Japan's defense, and push companies to raise wages. She backs aggressive fiscal policy, including large spending packages and targeted tax relief, especially on essentials like food. She also wants the Bank of Japan to lock in inflation that comes from wage growth, not just higher energy or imported prices. On the fiscal side, her government has already signaled big packages to cushion households from higher living costs, support wage growth, and channel money into strategic sectors. That includes subsidies and tax measures aimed at energy, food, and child-rearing costs, combined with incentives for companies that lift wages. At the same time, she is willing to tolerate and even embrace higher nominal growth with higher inflation, rather than sliding back into a deflation trap. The catch is simple. Japan already has one of the highest public debt loads in the world relative to the size of its economy. More fiscal spending means more bond issuance and more pressure on the JGB market, at a time when investors have already tested the Bank of Japan's resolve several times. Bond vigilantes are watching for any sign that Japan will either lose control of yields or sacrifice the yen to keep borrowing cheap. The Bank of Japan is caught in a three-way squeeze. On one side, it faces domestic pressure from a prime minister who wants wage-driven inflation and a clear exit from deflation. On another, it faces market pressure to stop suppressing yields and to normalize rates as other central banks have done. And in the middle are households and firms, many of whom hold variable rate debt or rely on low borrowing costs to survive. For years, Japan ran ultra-low or even negative interest rates and capped long-term yields through yield curve control. That regime is now shifting. The Bank of Japan has already started to loosen its grip, allowing yields to move higher and signaling that negative rates will not come back lightly. Takaichi's push for wage-led inflation strengthens the case for a more normal rate structure over time, but it also raises the risk of sharper moves in both yields and the currency. Takaichi's agenda is not just about inflation and wages, It is also about power. Japan has approved record defense budgets and is on a path to spend around 2% of GDP on defense. The money goes into missiles, maritime security, cyber capabilities, and joint projects with allies, especially the United States. This buildup sends three signals at once. To China and North Korea, it says Japan is no longer content to rely only on U.S. power for deterrence. To Washington, it says Japan is willing to shoulder more of the regional security burden in exchange for a tighter technological and defense partnership. To investors, it says that defense and security-linked supply chains in the Indo Pacific are going to matter more for earnings, cash flows, and risk premia. Japan is one of the largest foreign holders of U.S. Treasuries. Those holdings exist because Japanese institutions looked abroad for yield when domestic rates were pinned near zero. If Japanese yields rise and domestic bonds look more attractive, the relative appeal of U.S. Treasuries shifts. For years, global investors used Japan as a funding base. Borrow in yen at ultra-low rates, convert to dollars, and buy higher-yielding assets like U.S. stocks, credit, or real estate. If Bank of Japan normalization continues and yen funding costs rise, the economics of that trade change. Unwinds and carry trades tend to show up as sudden moves in currencies, bond yields, and risk assets, not slow, polite adjustments. If you're holding short-duration bond funds or strategies that benefit from higher volatility, you are better positioned for a world where Japanese yields move and carry trades are less stable. If you are heavily exposed to long-duration government bond funds that priced in permanently low global yields, you are the one who gets squeezed when Japan finally shifts. For decades, Japan was the classic stakeholder model. Companies looked after employees, suppliers, and stability as much as shareholders. Under pressure from both domestic reformers and foreign investors, that is changing. Takaichi's pro-growth stance builds on an existing push to raise return on equity, clean up balance sheets, and encourage buybacks and dividends. For investors, this shift means two things at once. First, Japanese large-cap equities look more like a shareholder value story, with more focus on margins, capital allocation, and governance. Second, the combination of fiscal push, higher defense spending, and corporate reform creates a new mix inside Japan's weight in global equity indices. Let's translate all of this directly into products you might hold. If you are holding broad global equity index funds, Japan is a single but important slice of your exposure. Under Takaichi, that slice tilts more toward companies that benefit from fiscal spending, corporate reform, and defense outlays, and away from the pure deflation-era cash hoarder profile. If you are holding sector or thematic ETFs, here's where you feel the change most. Defense and aerospace themes with Japanese exposure benefit from higher defense budgets and closer security ties with the U.S. and partners. Japan financials and bank-focused funds face a more complex picture. Higher yields can help margins, but a messy exit from ultra-low rates can stress borrowers. Asia Pacific or Indo Pacific security and infrastructure themes can gain from Japan's push to anchor more supply chains and projects away from China. If you are holding bond and income funds, the impact is even more direct. Short-duration treasury and global bond funds tend to handle rising yield environments better than long-duration funds that are highly sensitive to rate shifts. Global aggregate bond funds that include JGBs will reflect any move in Japanese yields, both through price changes and through shifts in index weights over time. If you hold products that explicitly target Japanese government or corporate debt, changes in Bank of Japan policy under political pressure become one of your key risk factors. Here's who quietly benefits if Takaichi's agenda stays on track. Sectors tied to defense, infrastructure, and strategic technology in Japan gain from stable, multi-year public spending. Exporters with pricing power benefit if wage-driven inflation lifts domestic demand without destroying competitiveness. Shareholder-focused Japan equity strategies benefit from corporate governance pressure and higher expectations for return on equity. Who gets squeezed? Long-duration government bondholders that relied on endlessly low Japanese yields are vulnerable if bond market pressure forces a faster normalization. Companies that refuse to adapt to shareholder value expectations risk lower valuations as capital rotates. Investors who ran heavy yen carry trades into risk assets without hedges face abrupt swings if yen funding costs rise. Scenario A. Takaichi keeps pushing large fiscal packages, the Bank of Japan normalizes slowly, and markets give Japan the benefit of the doubt. In this world, the yen is weaker than in the past. Japan exports remain competitive, and equities benefit from a mix of inflation, reform, and defense spending. Broad index funds and Japan-tilted equity strategies tend to benefit, while long-duration bonds still feel pressure. Scenario B. Bond vigilantes lose patience. Yields spike. Bank of Japan tightening accelerates, and domestic borrowers with variable rate debt come under strain. Yen carry trades unwind, global yields jump, and risk assets see sharper drawdowns. In that world, short-duration bond funds and more defensive equity exposure hold up better than leveraged, rate-sensitive positions. Scenario C. Political friction slows or waters down the agenda. Approval ratings slip. Coalition partners resist, or external shocks force a pivot away from big spending. Japan drifts back toward a cautious, incremental path, and some of the investor optimism about reform and growth fades. Here, the risk is not crisis, but disappointment, and a gradual repricing of Japan's equity and bond risk premia. So, if you're an investor holding broad global equity index funds, here's what actually changes for you. Japan's slice in your portfolio becomes less about deflation and cash hoards, and more about a political experiment in using fiscal power, defense spending, and corporate reform to escape stagnation. If you're holding bond and income funds, Japanese policy becomes a quiet driver of the yield curve and the relative attraction of U.S. Treasuries versus other developed market debt. If you're holding sector or thematic ETFs in defense, financials, or Asia-Pacific infrastructure, Takaichi's mandate is not background noise. It is one of the forces that will show up in your performance over the next cycle. Japan spent 3 decades trapped between deflation and debt. With Sanae Takaichi's election win, it has chosen a much riskier path. Spend more, arm more, and push for wage-driven inflation while sitting in the middle of the US-China rivalry. For you, the takeaway is simple. You don't need to trade Japanese stocks every week, but you do need to understand how one election in Tokyo can quietly move the bonds you hold, the currency risk in your funds, and the sectors that drive your long-term returns. That's the end of today's story. If you enjoyed this or learned something new, please hit the like button and subscribe to my channel. Thanks for watching, and I'll see you soon.